Okay guys, in Chapter 9 we're going to be looking at some more issues related to inventory. So the first one has to do with something called lower of cost or market value, and this exercise is usually done at the end of the year when we're doing our final financial statement and follows the conservatism principle that basically says report our assets at the lowest value. So let's take a look. Circumstances arise after purchase or production of inventory that indicate the company will sell inventory for less than its cost. Maybe it's damaged, there's deterioration on it, it has become obsolete itself, or price levels have changed. So that means if we had to, when we're selling our inventory, we're actually going to have to sell it for less than what we paid for it. When this happens, this reduced ability to sell, GAAP requires companies evaluate their unsold inventory at the end of each reporting period to see, geez, are we in this situation? And what results is, or may result, is the write-down of our inventory from what we paid for it to what its value is at the end of the year. So when the expected profit of unsold inventory is estimated to have fallen below cost, so revenue and certain things taken out of it is less than what we paid for it, companies must make an adjusting entry known as an inventory write-down to essentially reduce inventory so that the lower value is reported as an asset, and it will also reduce net income because we're going to charge it off as a loss. The approach chosen by the company depends on whether they use FIFO, LIFO, or average cost to account for their inventory. The financial statement effects will be the same, and the difference is the amount of the inventory write-down. So if you use FIFO, average cost, or some other method besides LIFO or retail inventory, which we're going to show you in this chapter, you use what's called the lower of cost or net realizable value. If you use LIFO or retail inventory, you use lower of cost or market. So it's just two different approaches to determine if your inventory value, whatever that is, we're going to show you, is less than its cost. So the net realizable value method, this is for FIFO and average cost people. We calculate what's called net realizable value. So think about it, net, so after we take out any expenses, realizable, what we're actually going to get. And that's determined by taking the selling price of the good minus any costs you still have to pay to complete the inventory, dispose of it, or transport it to the customer. So how much are you going to make on that sale net of those items? At the end of the year, a company compares the cost of its ending inventory. So how much did the item cost? How much is its net realizable value? That being the calculation. If the net realizable value is lower than what the cost was originally, then the net realizable value becomes the new amount of the inventory for the end of the year. If cost is lower than net realizable value, then you'll sell it for more than you paid for it. Inventory remains at the amount you purchased it at. So applying this, here's Collins. I know this is kind of small. It should be in your book though. Collins Company has 5 inventory items on hand at the end of the year. The year-end cost, they use FIFO, and net realizable value, so the current selling price less the cost to complete it, for each item are listed below. So items A and B are a collection of similar items, and items C, D, and E are another collection of similar items. Each collection can be considered a category of inventory. So what we can do here is, and you have choices, you can determine the lower of cost or net realizable value by item. So, and that's the first column there, by individual item. Cost is less than NRV for item A, so the cost of the ending inventory will be $50,000, the value you're going to use for it. In item B, though, net realizable value is less, so use the $90,000. In item C, net realizable value is less than cost, so the value of ending inventory is the net realizable value. Same with D. But in E, cost is less. So you can do this exercise by individual item like we just did. Add them all up. The cost of ending inventory then is the value of it is $395,000. Currently, the debit balance in inventory is $415,000, the cost. So we would have to do a journal entry for $20,000 crediting the inventory. So that's one way. Another way is by category. So instead of taking each individual item and doing this, take a total for each category. So what's the total cost of items A and B? What's the total NRV? All right, in that case, comparing the cost to the NRV for that category of item, the cost would be less. Do the same for items C, D, and E. The total cost of those items, $265. The net realizable value, $256. So we would use $256 as the value for that category. Add the first category to the second category. In this instance, the inventory would be at $408,000. Compared to the $415, we would have to write it down. I'm sorry, $406,000. We would have to write it down by $9,000. The final way you can do this is take the total cost of everything compared to the net realizable value of everything. In this case, the total cost would be $415. So that would be the value of inventory. So you have choices there when applying this exercise. In the end, so if you did this item by item, like that first one we went through, the value of your ending inventory should be $395,000. So you will debit cost of goods sold, $20,000, and credit inventory, $20,000. Write it down to the value it should be at. So this is lower of cost or net realizable value. FIFO and average cost people use this method. Here's a quick check. The following information pertains to one of the inventory items of Forge Company. So cost, replacement cost, selling price, cost to sell. So we take the selling price minus the cost to sell, which would make the net realizable value $240, compare it to the cost. The lower of the two is the amount the item should be valued at, $240. Here are some differences between GAAP and IFRS. US GAAP, we don't allow for reversals of write-downs. We could go by individual items, categories, or the entire inventory. IFRS usually is applied to individual items. So there's some differences. I'm just going to give you the answer there and keep going. We just talked that. Now, what about the people who use LIFO or this retail inventory value method, which you'll understand more as we get through this chapter? They have to do this exercise a little differently, and it's a little bit more involved. What they do is they find two extremes. The first extreme is the ceiling, or the highest amount. The second extreme is the floor, or the lowest amount. So a ceiling is calculated as net realizable value. So selling price minus costs to complete. Transportation. That's called our ceiling, the top. The floor is net realizable value minus a normal profit margin. So you would need to know how much do they usually make dollar-wise on this item. If the replacement cost, now we call that market, the replacement cost is the amount it would cost to buy that item today, company, not how much the customer is being charged, but how much the merchandiser would have to pay to replace that item today. Which would be the end of the year. If that amount is between the ceiling and the floor, then that's considered the market. If that replacement cost is above the ceiling is the market. If the replacement cost is below the floor, then the floor is the market. So the market, the highest amount it could be is the ceiling. The lowest amount it could be is the floor. If that replacement cost falls between, then the replacement cost is the market. We compare that to the cost. Take a look. So ceiling again is selling price minus estimated selling costs. Net realizable value minus the normal profit margin is the floor. Here we have Collins Company. They have 5 inventory items on hand at the end of the year. The year-end selling price and estimated costs of completion, disposal, and transportation for each are given. The normal profit margin is 20% of selling price. These amounts are used to calculate the ceiling and the floor. So that's all we're doing here is calculating the ceiling and the floor. So selling price minus estimated selling cost will give us our ceiling. So that's the highest the market could be. Multiply the selling price of $100,000 times 20%. That's the gross profit. Subtract that from the ceiling, and that gives you your floor. So you would do that for each item. So we're just calculating the highest the market could be and the lowest. Now, how do we figure out the market? Market will be the replacement cost unless it's above ceiling or below floor. Take a look. So we know the cost of the item is $50,000. Replacement cost. If the company had to buy that item today, it would cost them $55,000. Today being December 31st. Our company uses LIFO. So we calculate the ceiling to be $85,000 and the floor to be $65,000. So the market can't be more than 85, but it can't be below 65. Our replacement cost is $55,000. That's what we compare. We put the replacement cost. Where does that fall? It falls below floor. So our market value will be the $65,000 market. Or I'm sorry, the $65,000 floor. Compare cost to the market, the cost is lower. Take a look at the next one. Our cost is $100,000. If we had to buy that item today, it would be $97,000. We calculated the ceiling to be 90, the floor to be 66. The replacement cost is above the ceiling. So the most the market can be is the ceiling, $90,000. If that replacement cost falls between our ceiling and the floor, then that's a different story. But when it's above the ceiling or below the floor, then the ceiling or the floor will be your market. When we compare cost to market here, market is lower. Now look at C. Cost is 80, replacement cost is 70. Ceiling is 75, floor is 57. The replacement cost falls between the ceiling and the floor. It would be in the room, right? If the replacement cost is in the room, that's your market. Compare that to cost. The lower of cost or market, 70,000. And you do the same thing with the next two. Once you determine the lower of cost or market, applying that exercise, total up what your inventory value should be, 387,000. What is it currently at? The cost, 415. So you would make an adjustment for $28,000. Debiting cost of goods sold and crediting inventory. Just like we did before if you were using FIFO or average cost. It's just you're taking extra steps, extra calculations, defining that market so that it's not above a ceiling, the most it can be, or not below a floor, the lowest it could be. So you can also do this type of analysis by category and by total, like we did for our first levels. So applying the lower of cost or market, now we need to know replacement cost, selling price, costs to sell, and a normal profit margin, and that's a dollar amount there. So first calculate your ceiling, selling price minus cost to sell, 240. Right? So the highest it could be, ceiling, 240. Subtract your gross profit of 31, 209. So the highest your market could be is 240, your lowest 209. Your replacement cost falls between 225. So that means your replacement cost is the market. Compare 225 to the cost, the lower of those two is what is your value, 225. And there's your calculation again. So I know it's a little bit more involved. I remember learning this going, why are they doing this? And there are reasons, because we don't want to value your inventory too high or too low. Valuing it too high will cause your gross profit to be too low when you sell that item, and valuing it too low will cause your gross profit to be too high than it normally would. Because remember, you're pricing your items on cost. And now we're saying, well, you can't use cost, you got to use market. So we don't want your market to cause your gross profit to go too high or too low. And that's the reason for this exercise. So that is the lower of cost or market. Another method to value inventory. When would you use this? It's usually just to estimate inventory very quickly. So it's not an acceptable method. It may be because you need to know you're a loss in a fire or a tragedy. So it's just a quick computation. It's called the gross profit method. And it's just used to estimate inventory. So it's used in determining cost of inventory that has been lost, destroyed, or stolen, estimating inventory and cost of goods sold just for interim reports, in auditors testing over the overall reasonableness of inventory amounts reported by clients, and we use it for budgeting and forecasting. So we don't use it to prepare financial statements. How do we use it? Well, first we need to think about cost of goods sold. Remember, beginning inventory, we should know that we should already have the accounting records for that, and you need to have those in order to use this method. You also need to know all your purchases. If you don't know that, then you can't really use this method. That will give us all the items we have for sale. and this is normally how we calculate cost of goods sold. We go out and take a physical count of our goods. That gives us cost of goods sold. Well, gross profit method flip-flops cost of goods sold and ending inventory. So we still need to know, what did we have in the beginning? What did we add during the period of time? Because we need to know what was everything we could have sold when we're estimating for ending inventory. Then we estimate cost of goods sold based on our sales. So we need to know how much sales revenue we had. So if we've lost all those records, you can't really use this method. That will help us estimating ending inventory. Let's see it in action. The beginning inventory of this company is $600,000. They know that from their records. They also know that they bought $1.5 million more in inventory, net purchases, during the year. So everything they could have sold cost them $2.1 million. The company knows it sold and charged their customers, their sales, $2 million. But that's the selling price of the goods. We need to figure out, well, how much did those goods that they sold cost? And the company estimates that they have a gross profit per item of 40%. So 40% of that $2 million is profit, or $800,000. Well, if that's the case, then if we subtract the profit from the sales, that will tell us how much our cost of goods sold were related to those items. Okay? Because remember, sales minus cost of goods sold gives us profit, gross profit. Well, if we can calculate the gross profit and subtract it from sales, we just estimated the cost of the goods that were sold. So if the cost of everything we could have sold cost $2.1 million, and we estimate we sold goods that cost $1.2, then our estimated ending inventory is $900,000. And if you're going, wow, that's pretty sketchy, you know? Well, yeah, that's why we don't use it for everything. It's just a quick method to determine ending inventory if we need to. So the key to obtaining good estimates is having a good profit ratio. What if you have 50 different items and they all have different profit ratios? Yikes! So the accuracy of the estimate can be improved by grouping like inventory items or like gross profit items into pools. The company's cost flow assumption should be implicitly considered also when estimating the gross profit ratio. Any suspected theft or spoilage would require an adjustment to the estimates. So there's a lot of stuff that could, that is involved that could make this number bad. We just want to be careful how we're using it. One more example. The records of Oregon Timber, Inc. reveal the following information related to inventory destroyed in a fire. So inventory begins at $900,000 and purchases to the date of the sale are $480,000. So if you take 900 times 480, everything the company could have sold cost $1,380,000. The net sales to the date of the fire were $1,350,000. Now think of this. If sales represents 100%, gross profit is 30% of that 100%. So what does that mean? 30% of our sales is left as profit. So that means 70% of our sales are cost of goods sold. So take the $1,350,000 times 0.7. So the estimated cost of goods sold would be $945,000. Subtract that from your $1,380,000. Estimated ending inventory, $435,000. And there it is again. So what I did there was, instead of taking $1,350,000 in sales times 30%, that would have been $405,000, and then subtracting that 405 from 1,305,000, the 1,350,000 to get 945, I just said, okay, sales are 100%, 30% of sales is profit. So that means 70% is the cost. 100 minus 70, minus 30, I'm sorry. All right, so that's our gross profit method, just used to estimate ending inventory. Now, the retail inventory method is used by high volume, so they sell a lot, retailers that sell many different items at a low unit price. Okay, so clothing stores, the Walmarts of the world. First, it's estimating the amount of ending inventory. Okay, now what we do is, and this is a quick way to estimate for interim reporting, you estimate the amount of ending inventory at what you can sell it for. Okay, so how do we do that? Well, how much could we charge for all of the stuff we could sell? What would we charge our customers? Okay, so everything we could have sold, this is how much revenue we would have made. Well, how much did we actually sell? The difference between that is what's left, but it's at retail, at its selling price. We don't value inventory at its selling price, we value it at cost. So we end up multiplying the retail percentage, or the retail ending inventory dollar amount, by a cost to retail percentage. How do we get that? Well, the general calculation is to take the cost, the total amount of the goods that we could have sold at cost and divide it by the goods available for sale at retail. So again, we're going to need to know certain information and track it. So here's a general calculation. We're going to expand on this. So notice there's two columns, one at cost and one at retail. So our beginning inventory, and we need to track these things. So if you don't keep track of these things, you can't do this method. We need to know how much the cost of our beginning inventory was. So how much did the company pay for it? And then if we sold all the beginning inventory, what would we have sold it for? That's the retail. Then we add to that our net purchases. So that would be our purchase at cost minus our purchase returns, minus our purchase discounts, right, at cost, and add our freight in. The retail is the total revenue we would get if we sold all those purchases. So now we know we have two distinct numbers here, the cost of everything we could have sold and the revenue we would have received from everything we could have sold. So then we say, well, what percentage then is cost of the retail amount? So that's where we take the cost of $347,200 and divide it by the retail, $560,000. So cost is 62% of what we sell it for. Okay, well, if we sold everything, we would have had revenue of $560,000. Okay, well, how many sales did we actually have? 400. All right, so what's left? So our ending inventory at retail value is 160. Well, like I said, we can't estimate inventory at retail. We got to convert it back to cost. How do we do that? Multiply it by the cost to retail percentage of 62%. So the estimate of ending inventory using this method, 99,200, the estimate of cost of goods sold would be 400,000 times 62%, or 248,000. What they did here was they said, okay, what was the cost of everything that could have been sold? How much is still here? 99,200. Subtract 99,200 from 347,200. Another way of estimating inventory. Now we're going to start adding some things, kicking it up a couple notches. Because companies don't buy inventory, put a price on it, and leave it there at that amount forever. right? So companies have what's called the original markup. Okay, we ignore that, or the initial markup. Okay, we start with selling price when we start talking about markups. So let's say a company bought, I don't know, an Elmo doll. I know Elmo's not popular now, but I don't know what is. So we're going to pretend Elmo is the hot item for Christmas this year. So they buy an Elmo doll. They bought it back in September, and they put a selling price on it of $30. That's the initial markup. Okay. But now it's getting closer to the holidays, and they know Elmo's popular, and there's not a lot of Elmos. So the company marks it up to $50. So it went from an original selling price of $30 up to $50. We call that an additional markup, that $20. Okay. Now, let's say Christmas passes, or some other toy comes out before Christmas and blows Elmo away, and Elmo sales go down. Well, now the company's going, oh, we originally sold it for 30. Geez. And we marked it up to 50. We're not selling anything. We're going to have to bring it down to 25. So now they're going from 50 down to 25. We don't say that's a markup cancellation of $25. No. Here's what it is. The markdown from 50 to the original selling price, so that would be 20, that's a markup cancellation. So it's when they eliminate the additional markup. So that's number one. And then the price decrease from the original selling price of 30 down to 25 is called a markdown, an additional markdown. So we have to keep track as a company, additional markup on items and markup cancellations. We also have to keep track of markdowns. So when we mark it down from the original selling price, and if we eliminate that markdown, if we raise the price back up. So companies always have to keep track of that, but that's what they are. And there's a picture of it, what I was just explaining to you. So the original selling price, say of the Elmo, was $10. Well, the company decided to increase the price to $12. So now there's a $2 additional markup. If they decrease the price down to $10.50, now there's a markup cancellation of only $1.50. Okay, so that initial markup is ignored. If the original selling price is $10 and they reduce the selling price to $7, now you have a markdown of $3. If they increase the price up $1 to $8, that's canceling $1 of the markdown cancellation. Of the original markdown, I should say, and that's called $1 markdown cancellation. So as I said, to use this method, companies need to track those. So when applying this method, now we have things affecting our revenue. These net markups, so markups, markup cancellations, so they're net markups. Net markdowns are markdowns minus markdown cancellations. But they do increase and decrease our revenue from the original selling price, so they must be accounted for. Because remember, when we do our inventory at cost and retail, we're saying how much did it cost and what is its original selling price. So we're not accounting for these markups and markdowns that occur. Now we have to. So we have home improvement uses a periodic inventory system and the retail inventory method to estimate ending inventory and cost of goods sold. Here's their data. So they begin inventory cost $99,200, retail is $160. Their net purchases at cost are $305,280. At retail, $470. Now remember, net markups and net markdowns only affect retail amount, because it's the selling price that increases or decreases. So this company kept track of those items. Their net markups were $10,000. Their net markdowns were $8,000 on those items. And then they actually sold and received revenue of $434,000. So how would we calculate the retail inventory method? Well, we would do the same type of schedule. Let's add up all the costs of our beginning inventory and our purchases. Now, this is called retail inventory method average cost. And when you're using the average cost method, you include markdowns, but you subtract them because they decrease your retail value, right? So beginning inventory, that's at its original selling price, and so are the purchases. The net markups occurring during the year are tracked. They would have increased the selling prices of those items by $10,000. Net markdowns would have decreased the original selling price by $8,000. So if the company had sold everything, the retail value of it or revenue would have been $632,000. The cost of those items are $404,480. So let's do our cost to retail percentage. So if we divide the retail into the cost is 64% of the retail. Well, if we sold everything, we would have had revenue of $632,000. Well, we sold $434,000 of it. So how much is left? Well, ending inventory at its selling price is $198. We don't do ending inventory at selling price, we do it at cost. We'll multiply that $198,000 by 64%, and that's the cost of our ending inventory. If you subtract that from the cost of everything we could have sold, that will give us the cost of goods sold. Remember, it's estimating. So when we're using average cost as our retail inventory method, we include markups and markdowns in our calculation, in our total retail amount to determine our cost to retail percentage. Here's another example. Bowden Company uses the retail inventory method. The following information is available for the year. Now this company uses average cost just like we just did. So take a look. We would take the ending inventory at retail, $1,300,000 plus $3,670,000 plus the markups minus the markdowns minus the net sales. So the estimated ending inventory at retail, $1,340,000. What's the cost to retail ratio? Well, the cost of everything, $780,000 plus $2,804 million, divided by $1.3 million plus $3,670,000 plus the markups of $150 minus the markdowns. That percentage, 71.2525%. So cost is that percentage of retail. So if we multiply the ending inventory at retail, $1,340,000 times 71.2525, the estimated cost of ending inventory, $954,784. Okay, so that's one method of using retail inventory for the average cost. Another method is the conventional method. Now, take a look, same information. But when we're calculating our cost to retail percentage, we do not subtract markdowns out of our retail value. So, we still have cost, beginning plus purchases. The retail value, so the original selling price of our beginning inventory is $160. The original selling price of our purchases are $470. But just add net markups at this point. Now calculate your cost to retail percentage. So you notice our percentage will increase, 63.2%. Now subtract net markdowns, then subtract net sales to get your estimated ending inventory at retail. So we're just not subtracting it to get the total to include in our cost to retail percentage calculation. We don't subtract it when we're using the conventional method of retail inventory method. Now, we'll multiply our cost to retail percentage we calculated under this method, 63.2, by the ending inventory at retail, 198, 125, 136. So you notice our inventory amount is less. Now, what if we use LIFO? Well, there is a LIFO retail method, but it's a little different than what we've been looking at. So I'm going to read through it, but it's better to just see it. When there's a net increase in inventory quantity, LIFO results in ending inventory that includes the beginning inventory as well as one or more additional layers added during the period. When there's a net decrease in inventory quantity, LIFO layers are liquidated. Ouch. So in applying LIFO to the retail method, we assume that the retail prices of goods remain stable during the period. We compare beginning and ending inventory in dollars to determine if quantity has increased or decreased. Let's take a look. So here's what we do. First, we calculate two distinct percentages for converting our ending inventory to retail. The first is our beginning inventory ratio. So we will take our $99,200 cost divided by 160,000 retail. So the beginning inventory cost to retail percentage is 62%. Now remember, this is LIFO. Then we'll calculate a cost to retail for the purchases during the year. So the cost of our net purchases, $305,280. The retail of our purchases, $470, plus net markups minus net markdowns, $472,000. So we're going to divide $305,280 by 472, 64.68%. So we have two separate ratios, one for last year's inventory that came over into this year, and one for this year's purchases. We add the retail beginning inventory to the retail purchases, $632,000. So the $160,000 plus $472 will still give us $632,000 of retail. And then we add the cost of beginning inventory to the purchases at cost. So the cost of everything we could have sold, $404,480. Okay. What do we do with those numbers? Well, we don't do anything with the cost. Now we want to subtract the amount of sales from our retail value. So the estimated ending inventory at retail is $198,000. But how do we determine the cost? Before we just multiplied it by a percentage. Nope. Here's what we do. We say the retail value of beginning inventory was $160,000. So the first $160,000 of our ending inventory at retail is really from beginning inventory. Remember, isn't that what LIFO is all about? We keep the really old stuff. We remove the newer stuff. So the first $160,000 of our retail value of $198 will be multiplied by that cost to retail conversion of beginning inventory, 62%. So the cost is $99,200. The remaining layer to get us up to a $198,000 retail ending inventory, or $38,000, will be converted at the cost to retail percentage for this year's purchases, because that's where that $38,000 is from. 64.68%. So $24,578. You add those two together, That's the estimated cost of our ending inventory using LIFO. We would subtract that from the cost of everything we could have sold. That would give us our estimated cost of goods sold. So a little different, but still keeping the spirit of LIFO. Wow, so let's take a little bit of a recap. Remember, freight in, okay, is already included in net purchases. And that's the only in the cost area. If there are purchase returns listed separately, you would deduct them both from cost and retail. So that was already done for us. If there are purchase discounts, we deduct them just from the cost column. Sometimes the company has abnormal shortages, spoilage, so things might go bad, breakage, things are dropped, or theft. If we have those amounts, we're going to deduct them from cost and retail. So this is what you do with these items if they're stated separately. After calculating your cost to retail percentage, net sales. So total sales less sales returns. So that amount is already deducted out of our retail. Normal shortages. So up in the top are abnormal. Normal ones, and that would have to be defined, are deducted after calculating that cost to retail percentage. If the company has sales discounts or employee discounts, they are not already subtracted out of net sales. So let's take a look at the conventional retail method. Bowden uses the retail inventory method. Conventional. So remember, these different methods are just the way we're calculating our cost to retail percentages. All the items we talked about originally are added and subtracted. So we have cost 780, retail 1,300,000 of the beginning inventory. Net purchases for the year, 2.804 in cost, 3,670,000 in original sale price. Markups on those items, 150, markdowns are 90, and they sold 3,690,000. Remember, when you're using the conventional retail method, so you can add you can make your columns if you want. Right now, you'll have a column for costs and a column for retail. You have beginning inventory, 780, 1,300,000. Purchases of 2,804,000 in the cost, 3,670,000 is how much we would have sold them for. Add your markups. Do not subtract your markdowns under this method before calculating the cost to retail percentage. So let's add the costs together. I'm getting a total cost of 3,584,000. And if I add my retail amount of beginning inventory to purchases to markups, I get 5,120,000. So my cost to retail percentage will be 3,584,000 divided by 5,120,000, or 70%. Now I subtract markdowns from retail, and I subtract what my actual sales were. So if I sold 3,690,000 and I subtracted my markdowns, ending inventory would be 1,340,000 at retail. Well, I need to convert it to cost, so I'm going to multiply it by 70%, and I get 938,000. And there is the calculation again. So under average cost, we do subtract markdowns before calculating our cost to retail percentage. Conventional, we don't subtract them before calculating our cost to retail percentage. If you thought it couldn't get any worse, right? There's a dollar value LIFO retail inventory method. So each new LIFO layer is added or increased in retail prices as our ending inventory exceeds our beginning inventory. Each layer year carries its unique retail price index and its unique cost to retail percentage. So, of course, it gets a little bit more complex, but let's take a look. So, we're still going to approach this as we do for LIFO. Okay, so 99,002 is our cost, retail, goods available for sale for the purchases, 305,280, retail 472. We still calculate our beginning inventory, cost to retail percentage 62%, cost divided by retail of only the beginning inventory, and then the 2021 layer cost to retail percentage, the cost of all the purchases for that year divided by the retail, including subtracting markdowns. Net sales are then subtracted from the retail value. Ending inventory is 198,000. But let's see how we calculate the ending inventory here. So jot that down, 113,430. Okay. So the first thing we're going to do is say, okay, we need to know a retail price index. Okay, so during the year, prices increased 10%. So step one, let's convert that 198,000 ending inventory at retail, okay, to base year, divided by 1.10. That's 180,000. Okay. Well, the inventory layer added this year would be 20,000. Our base year is 160. The retail value of inventory at the beginning of the year. And we just added another 20,000 due to quantity. So we're restating the end of year retail prices at base year, which would have been the beginning of the year. That just happens to be their base year. So the base year would be 160 times 1 times the cost to retail conversion for beginning inventory, 0.62, 99,200. The new layer we just added would be valued at 1.10, only that part of it will have the cost of 1.10 associated with it. But then we further multiply it by the cost to retail percentage to convert it to cost, 14,230. So you can see, of all the methods, this provides us with the lowest inventory value. And that's what we want out of LIFO. We want the lowest inventory value and the highest cost. So you couldn't escape it anymore. We carry dollar value LIFO with us into this chapter. Assume instead, well, maybe the next year, ending inventory is 226. Price index is 1.16, and the cost to retail percentage is 63% for that year. We're going to follow the same procedures. Take the end of the year 2022 divided by the cost index, retail price index, 1.16. That gives us a retail value of our current ending inventory at base year retail price. So the first 160,000 of that will be valued at 100%. The next 20,000 of the 195 is valued at 1.10 retail price index. And then we added another 15,000 of layer in 2022, which will be based at 2022's retail price index. We further multiply that new retail amount for each layer by its cost to retail percentage for that year. So maybe our records say our inventory is valued at 226,000, okay, at retail. But the cost of it under dollar value LIFO retail method, 124,392. Further, what if instead in 2022 our inventory is at 204,160. We divide it by our retail price index of 1.16. Now our inventory at base year costs are 176. So our first 160,000 at valued at 100% times the cost to retail percentage of 0.62 from that year. But then we start peeling away from that 2021 layer. Remember, 2021 originally had 20,000 in it. Nope. Remember, when the value at base year prices decreases from one year to the next, we peel off the prior year. So now this layer is at 16,000 times 1.010 retail price index times the cost to retail percentage for that year. There's no layer in 2022. You can't put a negative layer in. And then our concept check. So on January 1, 2021, they adopted dollar value LIFO. Okay, that's already. Beginning inventory is at 60, retail's at 94. So we have a cost to retail percentage for beginning inventory. Remember, we're going to take the 60 divided by the 94, 63.8%. Then we're going to find a cost to retail percentage for our purchases for the year. So it's very simple and straightforward. Cost is 201,500 divided by 310,000, 65%. Okay. All right. Now we're using dollar value LIFO. So first, let's see how much our estimated retail value, estimated ending inventory at retail value is. So we're looking for ending inventory. So we're going to add beginning plus purchases. That's the retail value of everything we could have sold. Well, we sold 300. So that's $104,000. Now it's that. We will divide the 104,000 by 1.04, which is the retail price index. So if this 104,000 in ending inventory was valued as of the beginning of this year, it would have had a value of 100,000. All right. Well, the first $94,000 of that retail amount are going to be valued at 63.8% or $60,000 cost, right? 94 times 100%. So the next 6,000 of it has a price index of 1.04 and a cost to retail percentage of 65%. So take the $6,000 that will bring it up to 100,000 times 1.04 times our cost to retail conversion of 65%, $4,056. So what's the value of ending inventory? $64,056. So there's the items I just did in that order. Okay, so the next part, that's it for estimating the inventory. What happens if we have a change in inventory method? Well, we have to revise our comparative statements if we report more than 1 year. The next step is we adjust affected accounts, inventory, cost of goods sold, and we disclose information. If you change to the LIFO method is used from the point the change is adopted, and that period's beginning balance is considered as the base year inventory. So for dollar value LIFO purposes. So Auto Geek, a wholesale distributor of auto parts, began business in 2018 inventory reported in the 2020 year-end balance sheet using the average cost method was $123,000. In 2021, the company decided to change its inventory method to FIFO. If the company had used the FIFO method in 2020, ending inventory would have been $146,000. What steps should AutoGeek take to change this? Well, they have to debit their inventory, $23,000, and credit retained earnings to get their inventory up to the value it needs to be at as of the beginning of the year that you're going to use it. And then they provide a description of what happened. I'm not going to read through all that, but there's a required note. When a company changes to LIFO from any other method, it usually is impossible to calculate the income effect on prior years. So to do so would require assumptions as to what specific LIFO inventory layers were created in prior years. So a company changing to LIFO usually does not have to report the change retrospectively, like we just saw. Remember, they said if they had used FIFO, the inventory balance would be at this amount, and you have to change it to reflect that amount. Well, when you use LIFO, it's almost impossible to do that. So they say, okay, in the year of change, that's going to be your base year, and that'll be your amount going forward. So that'll be your 100% amount going forward that you would base your price changes on. And again, here is another description, a nature and justification for the change to LIFO. Why they didn't use retrospective application, so you could read through that. The effect of the change. So Belgery Company switched its inventory method from average cost to FIFO. Inventory at the end of 2020 were reported in the balance sheet of $55 million. If the FIFO method had been used, 2020 ending inventory would have been $50 million. So what should happen to beginning retained earnings? It should decrease by $5 million. Why? Because we're going to credit inventory for $5 million and debit retained earnings. We don't debit cost of goods sold. That change occurred from prior year undertakings. So that's a retrospective change. We change retained earnings. What about inventory errors? Inventory errors could occur from overstating or understating ending inventory. Maybe we made a mistake in physical counting or pricing or in recording purchases. How do we correct these? So if the error is made in the same accounting period, you just reverse the original entry and record the appropriate entry. But what if it's discovered next year or the year after? The previous year financial statements should be retrospectively restated. So you should change them. Incorporate incorrect account balances are corrected by journal entry. You must correct retained earnings as a prior period adjustment. Remember, you're going to, like if you wanted to debit cost of goods sold, well, the cost of goods sold is already recorded, so you want to debit retained, or I'm sorry, closed out for last year, so you want to debit retained earnings. And you have to use a note to describe what happened. So you can't just go changing stuff from one year to another when you're showing comparative, because last year you reported last year's information, and then you're reporting last year and this year. What if people start picking up financial statements and comparing? Well, no, you said your inventory balance was this much last year. Why is it this much for the same year on this year's? Wait, what's going on? So you want to be as transparent as possible. Sometimes it's very hard to visualize how inventory errors affect us until you get used to doing it. So remember, beginning inventory plus net purchases less ending inventory gives us cost of goods sold. Revenues subtract cost of goods sold, right? So if cost of goods sold is too much, net income is too low. If cost of goods sold is too low, net income is too much. And then net income increases or decreases retained earnings. So there's a whole effect there. So Barton Company uses periodic system. At the end of 2020, a mathematical error caused an $800,000 overstatement of ending inventory. Yikes! Ending inventories for 2021 and 2022 are correctly determined. Assume the error is not discovered until after 2021. So think about what happened. If the ending inventory is overstated in 2020, cost of goods sold was understated in 2020. That means net income was overstated. There wasn't enough expensed of cost of goods sold. And if net income is overstated, the retained earnings is at too much. What does that mean to 2021? Beginning inventory was too much. Okay. And when if you use your calculation here as you would in the periodic system, then it means your cost of goods sold would be too much. Okay, it would correct itself next year in retained earnings because the understatement, because you overstated too much in cost of goods sold in the second year, the understatement would come through a net income and self-correct. But yikes. So what does Barton do? Debit retained earnings as soon as possible, credit inventory. Okay, then cost of goods sold won't be affected. Beginning inventory will be restated so that it's at the true balance it should be at, decreasing at 800,000. We will correct retained earnings by debiting it, and there's no effect on this year's net income, even though it was self-correcting by itself. What happens if it's discovered 2 years later? If the error is discovered 2022, no correcting entry is required because it's self-corrected, right? We saw that. And this is for periodic inventory systems, remember. What happens if beginning inventory was overstated by 49,000 on January 1 and ending inventory was understated by 79,000? They weren't discovered until 2022. Hightower's cost of goods sold for 2021 would be overstated by 128,000. So beginning inventory was too much at the beginning of the year and not enough at the end of the year. So these things could get kind of crazy. I wouldn't drive yourself too crazy with them. Like we said, a lot of people don't use the periodic system. Just become familiar that there is over and understatement and how we have to correct them. Okay, the final item we're going to look at are called purchase commitments. And this is something totally different. It's just something we throw in this chapter, but it's when a company is obligated through contract to purchase a specified amount of something at a specified price on or before a specified date. So companies will do this if they fear that the price of an item is going to increase. It's really gambling too, but they sign a contract and they are committed to buy it. It protects the buyer against increases in purchase price and provides a supply of product. Inventory is recorded, though, at the lower of the contract price or the market price on the date the contract is executed. So let's see what this means. July 2021, the Lassiter Company signed 2 purchase commitments. The first requires the Lassiter to purchase inventory for $500,000 by November 15, 2021. The second requires them to purchase inventory for $600,000 by February 15th of the next year after the December 31st year end. The company uses a perpetual inventory system. when the contract period begins and ends within the same fiscal year. Okay, so they're going to commit and finish the purchase commitment in the same fiscal year, like that first purchase commitment. First, they're going to record the commitment. Oh, wait, I'm sorry. They don't have to record the commitment. When they purchase the goods, they're going to either record them at market price, the lower of market price, or the purchase commitment. Now, in this case, the market price ended up being greater than the contract price. So when they actually purchase them, they're going to debit inventory and credit cash. What happens if the market price is less than the contract price? Well, then there's a loss. They're committed to buy $500,000. If on November 15th, the amount of the market for these goods is $425, they can't just go, oh, it's cost less, we're only going to pay $425. No, you signed a contract back in July saying you would pay $500,000. So you took a loss on these. You can't say we bought $500,000, so the inventory is $500,000. No, lower of cost or market. So if the market value on the day you execute the contract, that purchase commitment is less, you've got to record the inventory at $425,000 and debit a loss on purchase commitment, which would go on your income statement. What if the contract period goes beyond the fiscal year, like our second one? The second requires Lassiter to purchase $600,000 of goods next year. Well, on the last day of the year in 2021, we're going to look and see if we had to execute that contract today, what would the market price be? The market price, if it is equal or greater to the contract price, we ignore it. We would actually be getting a deal. We're paying less than what they're selling for in the market. But what if the market price is less than the contract price? So we're required to pay more than what they're selling for at December 31st because we signed this contract. Well, now we have a loss on this as of December 31st, even though nothing happened. So they're assuming here the goods are selling for $540,000 on December 31st. That's what those numbers down in the bottom mean. So we're going to debit a loss on purchase commitment, $60,000, and debit a liability on purchase commitment because we're going to owe a extra $60,000 as of December 31st. Now, what happens when they actually occur? Let's say that the inventory does end up staying at a market price of $540,000 on February 15th. Well, we wouldn't record the loss in 2022 because the loss actually occurred last year on our purchase commitment. So we would credit cash for $600,000, debit our inventory for $540,000, and then debit that liability on purchase commitment. We don't debit a loss again, you already did. And because the loss occurred last year, we properly recorded it last year. What if we purchased them for $510,000? They decreased in value even more since December 31st. Well, credit cash for $600,000, debit the inventory for its market price on February 15th, $510,000. Debit the estimated liability for the portion of the loss that occurred last year, $60,000, and we would debit loss on purchase commitment for the additional $30,000 that has occurred since December 31st on this commitment. Okay, so those are purchase commitments. Remember, that's when a company wants to lock itself in so that they know they're going to get a certain amount of inventory, they know how much they're going to pay for it. The problem with these kind of commitments occurs if the actual selling price of the items is less than what you committed for, because now you have a loss. So on August 15th, Pesky Corporation signed a purchase commitment to purchase inventory for $300,000 February 20th. Of the next year. Their fiscal year is December 31st. They exercised the contract on February 3rd of the next year, and the inventory was purchased for cash at the contract price. On the purchase date, the market price of the inventory was $315,000. The market price on December 31st was $270,000. How much loss on purchase commitment will Pesky recognize in 2021? Well, they're obligated for $300,000. As of December 31st, the value is $270,000, so $30,000. Okay, so that's how we handle purchase commitments. Wow, that was a long one too, right? But a lot of different things. First, we looked at net realizable value, the lower of cost or net realizable value, two different ways: average cost, FIFO, net realizable value versus cost, the lower of those two. Then we looked at, if you use LIFO or the retail inventory method, lower of cost or market. And that's where we have to actually calculate a ceiling and a floor to determine what the market is, and then compare that to cost. We looked at the gross profit percentage method of estimating inventory. We looked at the various ways of retail inventory method. If we use the average cost assumption, if we use the conventional method, which is really lower of cost or market, if we use LIFO as our inventory method, dollar value LIFO. Then we looked at some inventory errors and then purchase commitment. So a lot of stuff. If you have any questions, please post them to the discussion board.